My name is David Yermack. I teach at NYU Stern, where I've been, 28 years on the faculty. And in 2014, which it's now been 7 years, we began offering what was really the first university level course on cryptocurrency. And back then it was almost entirely Bitcoin. And as you might guess, this has grown a lot. I think the first year there were 33 students, and they came from all corners of the university, like philosophy students and some engineers and so forth. But at this point, this has become very much an important elective at both Stern and at NYU Law School, because there's a lot of regulatory issues that our students are interested in as well. And we have hundreds of students. There's probably at least 500 people this year taking the course in multiple sections and so forth. And my colleagues ridiculed me in the early, like, what's going on with Bitcoin? And that changed very quickly. I was doing this not even a year, and I was invited to Basel to meet with the central bankers, which really meant what it sounded like. I sat next to Janet Yellen, and Rajan was there. He was the only guy I knew, but all of the big people. And they were scared to death of this, which only reinforced my belief that we needed to be teaching this and learning about it. So almost by accident, I ended up essentially starting over in a new field. After 20 some years of corporate finance and corporate governance, I decided I was going to study crypto. And it was just too interesting to take my eyes off. I thought, I'm no expert in this, but nobody else is either. So, why not get in on the ground floor? And this, I think, has been one of the smartest things I've done. So what I'm going to talk about today is what else is out there besides Bitcoin? Because if you look at the data, Bitcoin accounts, I think right now, for maybe 45% of the total crypto market cap. And, it's clearly the biggest and most important asset that's out there. But in many ways, it's also the most primitive and the most boring. And what I see in the peer review process on program committees for conferences, as a referee and so forth, is that the research is years behind, that people still write the large majority of the papers about Bitcoin. And it's not that Bitcoin isn't full of interesting topics, but I think to a great extent, people are missing the real story. And so what I want to focus on today is essentially the number 2 blockchain, Ethereum, which is much more ambitious and has much more capability than Bitcoin. And what I've found is that it's also extremely complicated, that most people don't understand it at all. And I want to go through in the first part of the talk some of the salient details. I'm going to make some comparisons with Bitcoin, but try to create an appreciation for what Ethereum is capable of. And then in the second part, hopefully the majority of the talk, we'll look at some of the standard applications that run on the Ethereum blockchain, the smart contracts, the initial coin offerings, which are pretty well covered in the literature, and then recently the NFTs, non-fungible tokens, and DeFi, decentralized finance. All of these things live on top of Ethereum. And this was definitely by design. The gentleman on the screen right now, this you probably know, is Vitalik Buterin, who created Ethereum when he was barely, I think, 21 years old. He had a lot of dissatisfaction with Bitcoin as a teenage early adopter. And so he decided to create a more versatile blockchain. And I think he's been a very clever entrepreneur, because he designed this in a way that you could build other markets on top of it. And so when you read about most of the interesting things going on in crypto, including many of the scandalous ones, it's because he laid the foundation for this. And I want to give you an appreciation for what this is capable of, but also what may lie ahead. Now, I would say there's a simple risk to Ethereum, which is that even as this blockchain has overtaken the Bitcoin blockchain, there's no reason someone can't come up behind Ethereum with something better. In fact, there's quite a few that are already out there. I think Cardano may be the number 3, but new ones are coming into the market all the time. And whether Ethereum is going to be able to defend its market position, or whether this will be more like the browser wars with the World Wide Web, where every 18 to 24 months there's a new Netscape Navigator or Internet Explorer or Google Chrome. They had very short half-lives until there was some stability. And I think we may be at the very early stages of a dynamic where you see increasingly versatile blockchains, and at some point Ethereum itself may become yesterday's news. But for now, I think this is really where people should be looking. And many of you who may be looking at NFTs probably don't realize how close the connection really is to Ether and Ethereum and so forth. So here are just some very basic overview data. It would be helpful to me if I could just take a quick show of hands. How many people in the room currently own or have ever owned Bitcoin? Okay, so this is not quite, I would typically get 50% of the MBA students, but it looks like, maybe a third of you guys. Now, the next question, how many of you have ever owned Ether? Okay, so 2, 3, 4. Okay, so there's some knowledge of this. I would invite questions and constructive criticism. I'm still learning about this myself, so feel free to jump in. And even if you're seeing this stuff for the first time, I think questions would be welcome. I don't want to do all the talking, in other words. So some of the very basic data, Bitcoin went live very famously in 2009. Very few people knew about it at the time, and it grew by word of mouth, but it took really a number of years to get traction. Ethereum, on the other hand, was a very public event, that it was first proposed in 2013 by Vitalik, and he created the first white paper that was used as an ICO. He was years ahead of the ICO wave. I don't think Ethereum was the very first ICO, but he sort of laid out the template for having a white paper and then pre-selling the tokens. He sold a whole bunch of Ether in exchange for Bitcoin. And it took 2 years of software development and beta testing. There's a lot of updating of milestones, a lot of anticipation, but this finally went live in 2015. And we have a charismatic founder who is closely associated with both blockchains. Satoshi Nakamoto, of course, has never been identified. And this is a huge difference that I'm going to come back to several times. Satoshi, as I think you all know, vanished sometime around 2012 or 2013 and left behind this enigmatic email that I've gone on to other things. And one guess is that Satoshi may even be dead, that he may have contracted the MRSA virus and died at a very young age. But Vitalik is deeply involved with the Ethereum project. And Satoshi, when Satoshi vanished, there was sort of a myth that Satoshi withdrew from the project to keep it truly decentralized. So the governance of Bitcoin would really be from the bottom up, and that there wouldn't be a dominant figure calling the shots. But it's exactly the opposite with Ethereum, that even though there's no president, there's in principle, it's decentralized, sort of like Bitcoin, and that no one person should be in charge. But there is no doubt about the influence and day-to-day importance that Vitalik comes to work every day and people essentially do what he says in the development meetings, subject to discussion and so forth. But he is very much the public face of this project. And given how young he is, he's still, I think around 26 or 27, is likely to continue running this, for many, many more years to come. So I updated this data just last night that after the big run-up earlier in the week, Bitcoin's worth a little north of 1.2 trillion, which is pretty good for a 12-year-old startup. And Ethereum is about, a little more, 40%, call it. It's about $500 billion. And there have been times in history where the values were actually quite close. In fact, in the big bull market 4 years ago, there was some belief that Ethereum might overtake Bitcoin. That didn't happen. But if I had to guess, and I don't like to speculate about the values of cryptos, but it seems to me that in the long run, Ethereum is destined, Ether is destined to be much more valuable than Bitcoin, although we'll see. Some other basic data. The Bitcoin blocks have been coming for 12 and a half years, every 10 minutes. And so right now there's 700,000, and in 10 minutes, there'll be 700,001. They keep coming. The blocks on Ethereum are much more rapid. They come every 12 seconds. So you've got, at this point, 13.5 million. And again, it will continue to grow indefinitely as long as people use the system. There are people who essentially keep the books and mine the blockchain that we call nodes. This can vary. Nodes can enter and exit the system, pretty much any time that they wish. There are no barriers to entry. Bitcoin right now has about 14,000 nodes, which is the highest number I can remember. It's usually around 10,000. And Ethereum has about 3,600. This is on the low side because some of these people have been diverted to beta testing and upgrade that is in progress. And we'll talk about this later. And still, you have many potential accountants and bookkeepers. And it is the competition among them that's essentially provides the security. So I think even 3,600 is more than enough. And you could get by with far less. And the consumption of energy and so forth has been very controversial for what all these people use up. And then, here's really where your attention, if you don't yet think Ethereum is important, just look at the disparity of transactions. You have essentially 5 times as much activity day to day on the Ethereum blockchain as you do on Bitcoin. And again, this is growing, and I think over time, Bitcoin will always be interesting, but I think it will be less interesting and more of a historical marker in this, and that other more versatile blockchains like Ethereum are destined to become much more important. So I think, the first and critical thing that you have to appreciate about Ethereum, yeah, go ahead. I can't hear you. If you could speak a little louder. I think the simplest explanation is that there are big choke points and bottlenecks on Bitcoin. There's only one block every 10 minutes, and each block can hold about 2,400, give or take. So these spaces get auctioned off, and you have to pay transaction fees to go to the head of the line. But this is capacity controlled, and that's been true for years. So there's a lot of unmet demand for Bitcoin transactions, but the Bitcoin that most people invest in are actually off of the blockchain. That if you bought Bitcoin, say at Coinbase, or if you're down in El Salvador using it to make consumer payments, you're actually not on the blockchain. You're with a third-party service provider who may or may not be trustworthy. So there are probably more Bitcoin transactions, but they're not real. They're kind of going to be offset in a big settlement or reconciliation by whomever that third party is. But this has been a huge issue, at least since 2015 or 16 for Bitcoin, that there is a capacity bottleneck, and it's been very hard to get agreement among the nodes about upgrades that might cure that problem. And Vitalik just tells people, we're going to expand, and I'm going to talk more about some of the ideas behind this, but the lack of leadership on the side of the Bitcoin is both a curse and a blessing. And, the blessing is that no one comes to dominate it, and it does resemble a type of democracy. But in the absence of true consensus, you've really had gridlock that has held back the growth of Bitcoin. I think in many ways, the inability to upgrade Bitcoin is the Achilles heel, the reason that it hasn't progressed and is probably destined to lose more market share to many other blockchains over time. So the nature of the transactions is very, very different. If you initiate a Bitcoin transaction, go to Starbucks and buy coffee or whatever, you essentially are asking the computer network to do one thing, which is to move coins out of my wallet and into somebody else's wallet. And Bitcoin does this in a particularly clever way, and it's quite different than traditional banking, but that's the only thing the network can really do. When you initiate an Ethereum transaction, you're actually starting a computer program. You're asking the miners to process code that will often be located off of the blockchain. In other words, the transaction may be a pointer to software that's located elsewhere. And the code can be really quite complex. Some of the simple applications we'll talk about are like basic insurance contracts and derivatives. Like if I don't make my payment by the 1st of the month, you can take my collateral and give it to that guy over there. But some of these can get quite involved. They can invoke other code. Code can then summon subroutines of code and so forth. And you can put these things together, and this is what's come to be known as decentralized finance, or the nickname is Lego finance, which is a whole bunch of little subroutines joined together, not unlike a big software platform. But every time you initiate a transaction, you're actually trying to activate a computer program. Now, there is a token that Bitcoin, of course, has the Bitcoin, and Ethereum has the Ether token. And the main use of the Ether token is not to go shopping at Starbucks. It's not meant to be a general spendable currency. It's really just used to pay the mining fees on the Ethereum blockchain. It's an internal token, really a utility token, as we've come to call the ICOs, that allows you to be a customer, to use the services of the blockchain. So I'll talk more about how these mining fees occur and so forth, because it's rather interesting. But there's a much more limited use. Nevertheless, the Ether tokens themselves are worth about $4,100 as of this morning. So these have become quite valuable. I think in the last year or two, they've run up in value even faster than Bitcoin in terms of the percentage return. Now, there are other tokens attached to these blockchains. And in the case of Ethereum, it's actually very easy because they provide templates that allow you to create your own token. So I think there are some university courses where one of the first homework assignments is everyone go create your own token. And you just download the ERC20 template, and then you try to sell these tokens to your classmates, the Dave token or whatever. But it's not terribly difficult. And I think this is part of the cleverness of Vitalik, is that he saw the opportunity to be the host of many other systems. So oversimplifying just a little bit, if you look back at the big wave of ICOs that began in 17 and 18, 3 or 4 years ago, I think about 75% of those still live on the Ethereum blockchain. They were created under the ERC20 template, as it's called. And it's really very easy to launch your own token in this style. And it's probably the most convenient way. It has a huge benefit for investors because if you know that the token is ERC20 compliant, that means it meets a certain technical standard. And there's all kinds of security and compatibility risks that you don't have to worry about because you know that it fits within a certain framework. And then much more recently, there's a more elaborate protocol called ERC 721, and a large share of the NFTs, the non-fungible tokens, NBA Top Shot, the Beeple $69 million tapestry, the CryptoPunks. We'll talk about these if we have time later, but most of these actually live on the Ethereum blockchain. And so many commands that might be given would simply be to move those tokens or to auction them off or to package them together or whatever. So you do see a limited amount of this on Bitcoin, and it's awkward. Bitcoin has a data field where you can give the hash code of some piece of information, and that might be useful for transferring things like the title of a car, the deed to a real estate property. But in reality, it's just very awkward to use it that way. But there's been one big success, which is the Tether coin first came to life as something that was attached to the data field on Bitcoin transactions. So there's a separate layer called the Omni protocol that was the original home of Tether, and it was built on top of Bitcoin, but people moved on. And I think Tether now is attached to many blockchains. And ideally, you want these tokens to be able to migrate from one blockchain to another, which sometimes they're able to do. So finally, the mining has always been proof of work, and I think will remain indefinitely proof of work on Bitcoin, which means that around the world, people spend a lot of energy guessing random numbers, trying to complete crypto puzzles. And there's no particular skill involved other than being able to guess random numbers really fast. And so there's special hardware that can do this. So Ethereum and many of the older blockchains also adopted this design, but because of the controversy of the energy involved, there is a migration to proof of stake. And I see that I was a victim of autocorrect. It's not proof of stake, proof of stake. And what proof of stake would be is essentially a lottery, where rather than having people guess random numbers and some person get lucky, it would be people who would be picked in a lottery weighted by their investment in the network, whoever has the most coins or has held them for the longest period of time. So there has been a fair amount of scholarship about proof of work versus proof of stake, including my own PhD student, Fahad Saleh, who wrote his dissertation on this. And it's been now about 2.5 years since Ethereum was scheduled to upgrade to proof of stake, but it keeps getting postponed. In fact, the most recent postponement was on October 5th, where it got kicked back for another 6 months. And now it might happen by June of 22, but I'm more and more convinced that proof of work is pretty robust and resilient. That, for all the ideas there are about saving energy and so forth, there are also hidden traps in proof of stake, and people are still trying to figure out what those are. So I want to talk in some detail about what they're trying to accomplish, because it's kind of clever, but I lack confidence that they'll ever get this done, because there's already been so many postponements that after a while you start to wonder, does this really work or doesn't it? And I think, they've reached a point where a lot of effort's been put into this, but still it's, months, if not years into the future. So one other very interesting difference, and I don't know if we have any Austrian monetarists in the room, who believe in hard money, but for many people, it's the design scarcity of Bitcoin, the very deterministic algorithmic growth where there will ultimately be only 21 million Bitcoin, and the rate of increase will be cut every 4 years by 50%. So we're already 13 years into this, and this is the actual growth in the Bitcoin supply. And you do have these sharp kinks where the slope falls by exactly 50% every 4 years. But what a lot of people think is that this is the way all central banks should be, that there should simply be a function for creating money that's very transparent, impossible to change, and ultimately will limit the circulation of coins so that you don't have inflation. Now, Ethereum takes a totally different approach. They don't have a limit. So there's no promise that they will keep it under any ceiling. And the approach doesn't really depart too much from what the Board of Governors of the Federal Reserve does, except it's really Vitalik. It's, it's a 26-year-old genius who thinks about how much should it grow. But the coins on both blockchains enter the system the same way, in that they're won by miners. And I'll talk in a moment about the complexity of Ether mining, which is much higher. But the rate at which they're assigned and the bounties and so forth are subject to fine-tuning that Ethereum has done with some regularity and is likely to continue to do. And so it's really a matter of judgment and trying to balance a number of competing interests. Now, if you look at the history, it's a little surprising that you see almost the same picture, that the growth of Ethereum up to now has been pretty similar to the growth of Bitcoin. But I think in the long run, this would probably not ever plateau at zero the way Bitcoin will. But to know for sure, you're going to have to come back in 50 or 60 years. And I hope at least a few of you are around to observe that when it happens. Let me just take a pause. Are there questions about, I don't want to just snow you guys under with details, but questions about anything I've presented or highlighted up until this point? Yeah.
I've heard stories of a mystery Bitcoin guy coming back at 21 million and pulling the string and having more. I mean, is there a clear ceiling of 21 million?
So you phrased that almost like the Wizard of Oz, and that may have been deliberate. So the code is very transparent. There's a source code for Bitcoin that you and I can inspect like anybody else. And there is definitely this protocol of cutting by 50% the growth rate every 4 years to the point that it eventually asymptotes to zero. But the code can always be changed. And this is true of all of these open source public blockchains, that any of us could go home tonight and say, you know, I have a better idea. Let's just cut it by a third and not by 50% the next time. And, you know, 21 million doesn't seem like enough. Let's continue, let's double it, you know, whatever. And what you need to recruit is a majority of the nodes that agree with your view of the world and will upgrade to the new version. So the vulnerability, you know, when people say it's fixed at 21 million, I always say, yeah, it's fixed for now, which means it's not really fixed. You know, it's fixed until we change it. And if you push this to the extreme, there ultimately is a political dynamic here. And you could imagine some charlatan populists saying there need to be more coins. And if you're looking for examples in history, you know, the populist movement of the 1890s is almost perfectly, you know, the free silver movement. There have been many elections in the US fought over monetary policy and easy money. And it's not too hard to imagine a takeover of Bitcoin where an upgrade of the software to increase the supply of coins, you know, could be put through. I think the best reason that might not happen is I expect this will fade away and become less interesting. But if it really becomes the world's money, you know, if everyone adopts it like El Salvador has, I think it will become a political issue that in the long run, it would be deflationary because not only does it not match economic growth, but coins are lost. And so the number that you get is not really going to be 21 million because all the ones that are lost can never be recovered. Some people think that 10% have already been lost. And the coins of Satoshi, you know, Satoshi, him or herself or themselves, Satoshi owns 1.1 million coins and they've never moved once. And so whether those are lost as well is a great question. And, you know, we may not know the answer to that, but I think the opportunity to intervene and change the blockchain could occur. The other thing that can occur if there's a dispute is the so-called fork, where, you know, let's say there's a critical mass of people, but not a majority who think the supply should be bigger. They can just diverge at a certain block and change the rules. Like as of a certain date, we're going to double the rate of coins. And you can recruit an army of the willing to follow you down the fork. And this has definitely happened on many of the major blockchains. So, you know, I think people shouldn't be too definite about this. But whether there's going to be a Wizard of Oz event, you know, time will tell. Lots of strange things have happened in politics, though, so it's not hard to imagine this. Yeah.
As you know, each currency has these set to have three options.
I'll go with this, but I have to say I'm reconsidering, you know, that one of the things I've learned is not to be so clear about the definition of money, but continue with the question. Yeah. Yeah.
Which of them are driving the growth of these currencies, cryptocurrencies, and how will you use them to predict the growth for comparison between these cryptocurrencies?
You know, I wrote my first paper on this question, limited only to Bitcoin, but the title was, is Bitcoin a real form of money or something like that? And I looked, you know, is it a unit of account? Absolutely not. Nobody anywhere in the world quotes prices in Bitcoin. They always quote prices in the local currency or maybe in the US dollar, but they'll accept the equivalent in Bitcoin, but that goes up and down. Is it a medium of exchange? Bitcoin is seriously challenged on that, you know, because of the capacity that we've talked about before. There's only so many people who can use it 4 per second worldwide. If there's a block every 600 seconds, and there's about 2,400 transactions in a block. Now, Ether has never tried to be a medium of exchange. So, you know, what I said a moment ago is that Ether is only good for one thing, which is paying the mining fees on the Ethereum blockchain. It was never intended that you would spend it at Starbucks or to pay your rent or anything like that. So, is it a store of value? Both of these are incredibly risky. You know, the volatility is higher than technology stocks, And as we sit here today in 2021, it's the same as it was 7 years ago in 2014. People thought it would come down and more people use it. And no, it hasn't come down at all. So as a store of value, it's, like, would you want to be paid your wage in Tesla shares and, keep shares of Tesla in your wallet to go shopping for groceries? I don't think it, these are very poor stores of value in the sense that they're not stable. Now, we can point to other cryptos like Tether has done great in, I think, 2 out of the 3. It's a very good medium of exchange, and it's a good store of value. What it is not at all is a unit of account, because it adopts the US dollar as the underlying, it just says we're going to have parity with the US dollar. So I think, Marcus Brunemeyer has written a very thoughtful essay about this. And one of his early points is that crypto unbundles the 3 uses of money. That, many of the coins try to do only one of the 3. And they do it maybe even better than the regular financial system. But there's a lot of other instruments like the social media platforms, especially in China, that don't have crypto assets, but nevertheless serve as payment systems with synthetic replications of the local currency. And it seems like a lot of the ones that have been most successful free ride on the government's unit of account and even the government's monetary policy, but nevertheless soak up a lot of transaction volume. But I have to say that I've never been less confident about the definition of money. This is changing right before our eyes. And I think for people who are finance academics, this is fascinating. This is like the most central thing we talk about is money. And the great contribution of Satoshi and the Bitcoin people is to reopen this discussion, which a lot of people hadn't thought about in years. And money in the modern world is, for my kids and so forth, is very, very different than the way we probably thought about it growing up. So, your question was, which of the 3 are these doing well? And I think it's none of them, none of the above. But they're useful for other things, and they've enabled other coins like Tether and so forth, other stable coins, to live on top of them and, sort of delegate those functions to those coins. But, that's why we have philosophy students in our class, because there's a lot of thoughtful discussions about the nature of money, which I personally find very interesting. Yes. Yeah.
Is it possible, again, we could be something similar to what happened with gold and currency? So the underlying asset is gold.
Yeah.
And then you determine, okay, my currency is gold. $10 is worth 1 ounce of gold, then it becomes $20 is worth.
I've definitely heard this conjecture, and the first person I heard from was Eric Posner, the law professor at Chicago, who wrote a report saying that you could have fractional reserve Bitcoin banking, that you could have essentially people holding real Bitcoins as the equivalent of the reserves that a commercial bank might hold at the Fed, and then lend against those and hypothecate Bitcoins, not unlike lending against bars of gold that would have been done in the 19th century. And there is definitely, I don't want to call them a cult, but a community of people who think that Bitcoin is the new gold, that it's destined to play this role in the financial system. My colleague, Aswath Damodaran, has a very heavily downloaded video where he discusses this. And many people attribute this idea to Aswath, which he doesn't actually agree with in the video. He just says many people think this, not that he thinks it. But you hear this all the time, that Bitcoin is the gold of the millennials. And what people have in mind is that it will become the reserve asset that other people use as a benchmark to go against. And I'm skeptical of this. Again, the supply, as we talked about a moment ago, can be manipulated by just changing the code. And I think, a skilled politician could enable this to happen. But I guess what I've often thought about in this setting, though, is no one really knows where the value of gold comes from either. Why is gold valuable? Because people agree it's valuable. And, why is Bitcoin valuable? For, much the same reason. But I don't think there's a lot of intrinsic value there that I'm comfortable with. So I don't know. I wouldn't necessarily expect that to happen, but there are people who think it might. Yeah, go ahead.
It's always fascinating when you show the graph, the growth of Bitcoin and Ethereum,
Yeah, here we go.
and how similar they are. It doesn't surprise you that one thing was coded what 7-8 years ago, and another thing is like more responding to the market forces, and still there is also
No, there's a lot of irony in crypto. And I was very surprised when I drew these graphs, which is why I laid them side by side so that everyone could see it for themselves. This begins in 2009. This begins 6 years later in 2015. But essentially, Vitalik has had forks that have been upgrades of Ether. And in choosing the new rules of mining rewards, more or less has gravitated toward what Bitcoin has done. Now, in the real world, of course, monetary policy has been very convex. The central banks are just going to the moon, printing money like no one ever imagined would be the case. So I can't say that they're trying to mimic, Bernanke and Yellen and, all the genius leaders we've had at the central banks of the world. But yeah, maybe there's something optimal about this that we need to tease out. Another result, and it's a totally different one, my colleague Thomas Philippon has a paper showing that the cost of financial mediation in the banking system going back to the 1880s, like 130 years, has been pretty much constant at 2%. Now, we can look at the mining rewards on Bitcoin and divide by the throughput of Bitcoin transactions. It's 2%. Yeah, it converges right back to what Philippon said was the problem in the old financial system. And I usually take about an hour to build up to that result in class, and the students all roll their eyes and say, oh, like we've accomplished nothing here. We're right back where we started. But I think at the very least, it raises questions about whether there are underlying market forces that we haven't understood well enough to say that they push to this kind of an equilibrium. It's great to wonder about these things, and maybe with time and more conferences and so forth, we get a little bit closer to some of these answers. So by all means, keep these questions coming, because it's maybe more interesting than my slides. So whoops, a little bit about the blocks on the two blockchains. So you have a storage limit, basically. The blocks on Bitcoin are limited by memory, and for most of the history, it's been 1 megabyte of transactions, which equals a little more than 2,000. And there was an upgrade called segregated witness that was kind of pushed through in 2017 that gave a minor amount of breathing room, and it's allowed the blocks to grow maybe 20%, 30% bigger, but it hardly begins to address the unmet demand for Bitcoin transactions. The goal is to have the blocks completely full. And that fails to happen a surprising amount of the time. And there's an outstanding paper by Lahar and Parler, Christine Parler at Berkeley, Alfred Lahar at Calgary, where they have conspiracy theories about the miners deliberately leaving the blocks partly empty so that they can jack up the fees that they're charging. And if the blocks are not 100% full, they're reasonably close, 80, 90% full most of the time. Ethereum blocks are totally different. They're based on the mining fees, which are known as gas. So you have to literally put gas in the tank of the contract. And you can only have 30 million units of gas, which you can think of as an amount of computational work that the network will be asked to do. Gas equals essentially the compiled work that a computer program is estimated to need in order to execute itself. So the goal on an Ethereum block is essentially to consume 30 million units of gas, but the target is for only half of that gas to be used. So an ideal block would use 15 million. And the mining fees on Bitcoin are winner take all. If you mine the block, you get the whole reward, which is currently 6.25 Bitcoin. So last I looked, it was 64,000 a coin. And so that reward is about $400,000 to somebody every 10 minutes. There are miners who sometimes find a valid block, but it turns out that someone found one quicker. And your otherwise valid block is called an orphan because it's left with nothing. It's totally different on Ethereum. You have what are called uncle blocks and nephew blocks, which are also valid blocks that for reasons of latency and delay don't make it onto the main chain, but the same amount of work was done to create those blocks. And the people who mine them are sort of victims of circumstance, so they actually get mining rewards too. So it's not a winner-take-all system. It's actually something that provides incentives to do the work and to spread the rewards more broadly. Now, if you just stop right here, this is a great mechanism design question. You know, if you're trying to get people to mine a blockchain, what's the optimal reward system under proof of work? And Bitcoin really pushes this to the limit, you know, saying it's going to be winner take all, one person gets the whole thing, and you can always come back and enter the next, you know, the next competition. Here, you kind of spread the rewards out. And the response of the mining industry has been to consolidate into syndicates, or as they're known, mining pools, that even though each miner gets the whole reward, they pre-commit to share with a large partnership. So we've got right now maybe 35 or 40 people. We could all go home and mine individually, or we could agree to share. If anyone wins, we would just give 1/35 to everybody, or we could share in proportion to the CPU power of our machines, you know, something like that. So my daughter joined a mining pool when she was 13. And yeah, I had nothing to do with this. I only found out about it later, and I was very proud of her. And she's applying now to MIT and Johns Hopkins and all the science schools. And you know, there's a lot of family drama fixed on this. But she got 58 cents ultimately. I said, how much money did you make? She said, I made 58 cents, which was her tiny little slice of what her laptop contributed, probably to a Chinese mining pool. And she didn't even know whose mining pool it was. But that's essentially how this has evolved, because the winner-take-all incentive is extraordinarily risky. So there are a number of papers, I think the best one's by Zhurgu He at Chicago, that has looked at the history of mining, the consolidation of the industry into syndicates. Now, you have a similar problem on Ethereum, or, you know, problem is a loaded word. I'm not sure it's a problem at all. But you see essentially an interesting I/O setting about how the industry will consolidate in the absence of any regulation. You know, in real life, if this were the banking industry, you have all kind of government interventions to hold down the power of any one bank. But here it's a total free-for-all. Nobody can stop these miners from working together. And there are many other blockchains with different reward systems, but I haven't seen much empirical research at all about how comparatively they've driven both the investment in mining capacity and the performance of the industry itself, the liquidity, the velocity of transactions, and so forth. The other question I had from my daughter was, who paid your electricity bill? Which I think, you know, cost more than 58 cents, but this was a good learning experience for her. So one other dimension to the mining is that if you want to get onto the Bitcoin blockchain, you have to give a tip to the miner. So you buy coffee at Starbucks and they'll charge you for your latte, what is it, $6 or whatever. But then you have to top that up with what is called a user fee, which is a tip that would go to any miner that takes your transaction. And there are some good papers studying these tips. And I think the best is by Easley and O'Hara, who've actually written a couple papers now on Bitcoin mining. And the presence of people like this in the field gives credibility to all of us, of course. But this system is well understood. This system is not, and it's much more complicated. What you do on Ethereum is pay a fee in two dimensions. You first put in enough gas to run the contract, and that's sort of determined by the complexity of the code. You then have different prices of gas. And you can essentially, you know, go for economy or premium or, you know, whatever, high test. But the more the price you put on each unit of gas, the quicker the miner will be to take your transaction. So it's a two-dimensional fee, and you specify, you know, the limit, how full you're going to fill the tank, and the price. And if you don't put enough gas in the tank, and sometimes people don't, your program just stops without executing all the way. And so contracts can actually run out of gas on Ethereum. And this just seems like a wonderful topic for a talk at a conference or, a paper. What goes wrong when contracts run out of gas? How often do they run out of gas? Would you deliberately cause one, to sabotage someone else's? There's all kinds of games that you could play with this. If you put in too much gas, by the way, you get it refunded. They return surplus gas that is not needed. But I kind of love the richness of this. And to date, I've seen 0 papers on it. And I just think, we don't need too many more papers on Bitcoin proof of work mining, but this is like unplowed turf. There's just, great stuff about the mining on Ethereum. And I urge you guys to invest some of your human capital in learning more about this, because I think it's going to be around for a while. Now, the big concern, of course, is that Ethereum may ditch this system altogether and move to proof of stake, and we'll come to this in a minute. So one other thing that I think people don't appreciate is exactly what information is stored in a block. So this is a Bitcoin block. And a block has exactly 4 pieces, each of which is quite small. So there is the hash code of the prior block, and you see these arrows then pointing back from each block to the prior block. So the way the blocks are chained is simply by carrying the hash code of the block into the header of the next block. There is the timestamp. There is the Merkle root, which is the consolidation of a tree of data through hash codes of hash codes of hash codes, but ultimately it's just 64 characters long. And then the nonce is the random number that you have to guess to complete the block. So it's just 4 things. And then in the body of the block is all the transaction data that gets carried along that fills up that 1 megabyte. But ultimately, to mine a block, you're just dealing with 4 pieces of information. Now, Ethereum has like 15 instead of 4. And you'll recognize some of the same ones. So this is the nonce from the proof of work mining. Here's the timestamp. Rather than 1 Merkle root, there's actually 3, which represent the balances in people's wallets at the start and at the end of the code, and the transactions that will map from here to here. And then lots of other data about the difficulty of mining at that moment, the gas limit of the contract, and then, of course, the hash of the prior block is here. So you have the same 4 pieces of information plus 11 more. So there's much more complexity here. And again, I've not seen any academic papers pull apart these blocks and look at the component parts the way we've seen on Bitcoin. So there are some great papers on the time stamping of Bitcoin blocks, because the miner can make up their own timestamp and they lie. And there are incentives to misrepresent the time of the block. There's a cute little paper at Cornell. It's actually an Ethereum paper where they used like very precise atomic clocks, and they sent transactions out for test purposes to see how they would be time-stamped by the people who blocked them. And I think something like 7% of them were time-stamped even earlier than they were sent, and so forth. And part of this is due to the latency of computer networking, but part of it is simply due to incentives to misrepresent the time. And there's other parts of this. To be honest, I really don't know what all this stuff is, but I'm sure it serves useful purposes. And I would like to see more papers, more of my own students spending some time to try to drill down and pull those apart. So the difficulty of mining resets every 2 weeks on the Bitcoin blockchain. And you've got a statistic called difficulty, which by convention equals 1 for Satoshi's first block in 2009. And today the difficulty is right around 20 trillion, which means it's 20 trillion times harder to mine a block today than it was 12 years ago. But it follows this interesting step function. And the reason it dropped so much in June and July was because China closed all the Bitcoin mines and kicked them out of the country. So this withdrew a whole bunch of capacity briefly from the network They've now restarted in places like the US and Kazakhstan. But within this 2-week reset period, people like to manipulate the timestamps to try to affect the next reset to make it easier or harder, as the case may be. Ethereum takes a totally different approach. It's a rolling reset. And they look simply at the most recent 3 blocks, they being the algorithm behind it. And if the average has been at least 10 seconds, but less than 19 seconds, the difficulty stays the same. But if it's taken any less or shorter, the difficulty changes to try to reset it to a target of 12 seconds. And what you see is, very much, it does kind of slope upward roughly like this, but it's much more of a random walk kind of thing. It does not have discontinuous jumps and so forth. A good question is, why did the Ethereum difficulty drop when the Bitcoin dropped? And I don't know for sure. There could have been Ether miners in China who also got evicted. I think what probably happened, though, was that the entire crypto marketplace dropped. And when the markets drop, the mining rewards are less, and so people pull back. They turn off the marginal machines. So I think this wasn't, I wouldn't say out of sympathy, but just because the overall price levels were dropping. So let's now talk about the upgrades to Ethereum. Yeah. No, the network resets the difficulty so that the target time is the same. So, if we had 35 people in the room mining and then 15 left to go to another talk, it would be less likely that of the 20 who were left that anyone would discover a solution to the block at the constant level of difficulty. So you need to make the problem easier so that one person will get it within 10 minutes. So it's based purely on recent history, that the reset on Bitcoin is the most recent 2 weeks. And with Ethereum, it's the most recent 3 blocks. But they're both recalibrating implicitly based on the supply of mining services, the number of people trying to mine the block. Yeah.
You said that there is no centralized administrator or something.
Right. So it's set by the source code. There's an algorithm. And this is exactly where I was going, that we can look at the history of Ethereum, and don't try to read this. I had to print it out and splice it together. But Ethereum has had these forks. The blockchain itself is only 6 years old, but you may recognize the names of Constantinople, St. Petersburg, Byzantium. The London fork occurred just last August. But these are upgrades where a whole bunch of changes get put through, typically by negotiation among development teams and big users and so forth. So, the answer, but who changes it, is that the algorithm has been updated fairly regularly, often a couple of times a year on Ethereum. And it's done in a public way with something resembling a political process. But you do have the philosopher king at the top of the pyramid, the great Vitalik. And the way in which decisions are taken here is it's a little bit murky, but they seem to have done a pretty good job of it up until now. So these forks, and there's 1, 2, 3, 4, 5, it's about a dozen of them on the slide. This is essentially the history of the code. Now, Bitcoin has had forks as well, and some of these are uncontroversial upgrades. Like recently, the multi-signature wallet, where you need not just one but several people to sign if you so choose. That was enabled. That wasn't contentious. Everyone thought this is an improvement. It's a thing that would be nice to have. But when there's real policy issues, it's been very hard for Bitcoin to get the kind of agreement that Ethereum has been able to get. So the major fork that Ethereum now has underway is the mining upgrade. And this is meant to transition to proof of stake. And the way it's set up is that this is the old Ethereum blockchain, and it's a proof of work system. And there's something out there called the beacon chain which is a proof of stake system. And it's been live now, I think, for the better part of a year. And at a certain point, these are supposed to merge. So when I said that this was delayed for 6 months, the date of the merger was just pushed back to June of 2022. Now, an interesting question is, how do you force these two chains to merge with each other? And the answer is that they've planted something called a difficulty bomb in the proof of work mining. So one concern, and I think it's a very real concern, is that these proof of work miners who have made big investments in hardware, they're looking at a lot of stranded costs, is what we would call this, like in a nuclear plant that gets abandoned. And they don't particularly want to switch to the new system. And so there've been talk of boycotts and, forks, all kinds of forms of civil disobedience. But ultimately, there's going to be a block where the difficulty of mining suddenly goes like from 20 trillion to 20 quintillion, or just some enormous explosion of difficulty that will make it impractical to continue to mine, and they'll have no choice. They'll be forced to merge if they're going to stay in the system at all. So this difficulty bomb keeps getting pushed back. I've, in fact, given you more information down here. Probably the most surprising thing I learned, though, in writing this talk is that this beacon chain has 150,000 validators who have each staked 32 Ether coins to be part of the beta test. Now, help me a little bit with the math here. 32 Ether, if I bought them right now, would cost $4,100 each, right? This is like $130,000, $140,000. You multiply that by 150,000 people who have done this, this is like a $20 billion investment in a beta test. For real. And maybe they're not telling the truth, but I'm really amazed at the amount of capital that's been committed to this. And the first question I have, and I don't have any idea what the answer is who are these people who've invested $20 billion in a beta test? And I'm guessing it's Vitalik and associates, that there's this thing called the Ethereum Foundation that has a reserve of Ether, and maybe they've rated that for use here. But this strikes me as one of the larger capital budgeting problems in the world right now, anywhere. And I'd like to know much more about it. I think, great paper topic for somebody, who's staking all this Ether just to take something on a test drive. So, apparently the test is not going well enough, to move ahead, because they were supposed to merge by December, but now it's kicked back 6 months into the new year. And this is only one of many postponements. This was, I think, originally due for 2019. Yeah. Yeah. So yeah, this is actually, I'm going to go through this in the next couple of slides. So yeah, bear with me. Yeah. No, you, Michelle. Yeah. Yeah, that's a great question. I think they'll just get their Ether back and go do other things with it. But I don't really know if it's locked up or whatever. There may be other people who are specialists who can answer this question, but I'm really puzzled, and who would put aside $20 billion for it? Yeah. Well, the rules on the new chain, the proof of stake, and this begins again to the question. Let me just skip ahead. They are going to have 32 blocks in what they call an epoch. And I wouldn't have chosen the same words, but there will be a committee of 128 validators who are candidates to mine each of these blocks. And one will be chosen at random. So there will be a lottery, and the lottery will be proportionate to the stake of each of those 128 people. So 32 is the minimum. You can't play if you don't put in, that's the ante to get into the game. But you have 64, you have twice as good a chance as the person next to you with only 32. So there are rewards for being the validator, which ultimately will be a lottery. But there's lots of other rewards for watching. The other 127 people are supposed to monitor the validators, or to monitor the miners. They're called the proposers. And if they do something shady, like try to double spend a coin or try to cancel a transaction that should go through, you can call a foul on them and collect a bounty for being a whistleblower. And there needs to be a 2/3 vote of the 128 validators to attest to the block. And, there's all kinds of choices and rewards. There's something called slashing, which also gets rewarded. And if you're caught doing something wrong, you have to forfeit your stake. Your 32 coins are confiscated. So, there's a big penalty for people who misbehave. But it ultimately relies on crowdsourcing to committees of 128 people. And the committees are reformed every 32 blocks, which are 12 seconds each. So this is like every 6 minutes, your committee is disbanded and you get put onto a new committee. And this prevents collusion and coalitions and so forth. So, there's a very interestingly worked out system. The other part of this, and I skipped past this, but they're going to take the blockchain and divide it into 64 shards, as they're called. So this to me seems like a great solution to the capacity problem, that a shard is a subset of the blockchain where you can send your transaction to any one of the 64 shards, and you can't send it to more than one or it won't be accepted. But it allows you essentially to segment and process 64 times as much traffic. You need to be sure that you don't run out of miners, because each of these needs its own committee of 128 and so forth. But with thousands of people participating, this doesn't seem like a problem. So, the transition, I'm not doing justice to all the complexity, but there's supposed to be a point next June, and maybe it will be then, maybe not. But this will essentially turn this into 64 shards, each of which has epochs of 32 blocks, which are staffed by 128 validators who each put up 32 coins. So, yeah.
Maybe I'll speculate about why it's taking this track, but it seems better for the system if they have more than 150,000 people, why not have 300,000? And all you need to do is keep the offshoots, the rebels, to as much, right? Like, so as soon as, I don't know if it's all right.
No, I think, what's interesting is these bounties, that if you can be a whistleblower and accuse people of slashing and get 2/3 of the people to agree that, that guy committed a foul, you get some of the reward. And we've talked about this in peer review, like, should we all have to post our code and data sets? And one of the best arguments against this is we'd have too many academic data trolls who try to make careers out of finding small mistakes in people's code. And you might have that problem here too. I don't know. And I think, getting the balance of the rewards right so that you have the optimal supply of monitors is a very interesting problem. So you've been very patient. No, I think it's really the energy cost. The proof of work is very costly and resources consumed. I have my own views that this is somewhat overblown, but it's undeniable that a lot of energy is consumed. So I read a cute little statistic last week that the amount of energy used in Bitcoin mining last year is the same as the energy used in gold mining, it turns out. And people get very up in arms about Bitcoin mining, like, how can society allow this to happen? The planet will, and no one says a word about gold mining. But both of them take energy. The allure of proof of stake is you just have to run a lottery, which takes no energy at all. You just pull a number out of a hat. And so it's to make the whole thing cheaper, really, and more economical. And I think that's a worthy goal. Yeah, no, there's been other proposals, and reducing the difficulty means you want it to take less than 10 minutes. So one of the early knockoffs of Bitcoin was Litecoin, and Litecoin just divided everything by 4. So instead of 10 minutes, it's 2.5 minutes target difficulty. There have been, lots of interesting proposals that, have led to some academic papers. The coalescence around proof of stake, I've been a little bit baffled by, because it doesn't seem to me like a problem-free system. But I would refer you to Fahad's dissertation, which tackled this with a lot of differential equations and so forth, and prove that it would really work well. Yeah. Yeah, you could. So there's a very rigorous system for communication across the shards. And for those of you interested, and I hope some of you are, there's really good publicity material put out about this that, you can just follow some of the links that I've put on the slides that I think I had one about rewards. Yeah, this one. But they've gone into great detail, much more information than I could cram into this talk. Okay, so this took, somewhat longer than I thought, but I'm glad we spent the time. Let me hit on some of the applications. And the original point of this, and I think, in fact, all of the things that go on Ethereum kind of fall under this umbrella, is the smart contract. And I'll come back to this example in a second, but I just want to highlight the work of Nick Szabo. He is a Hungarian mathematician who became a law professor. And he wrote this treatise in 1997, which is open source. You can download it. It was never peer reviewed. But he makes a very basic point that a contract is a series of promises, reciprocal promises. If you do A, I'll do B. And a well-specified contract could be translated into Boolean language and, essentially made into a computer program. And rather than us trusting each other and maybe going to court if we don't keep our promises, we just delegate to a computer the execution of the contract in such a way that it's irrevocable, that once the contract begins, it can't be stopped. So he writes that the basic idea is that many contractual clauses, such as collateral, bonding, and so forth, can be embedded in the hardware and the software that we deal with. And he goes on to say that the original smart contract is the vending machine, that you put in $2 and you get your Coke. And the machine doesn't try to renegotiate, it won't default, and it doesn't play favorites. Consider the guy on the left. And not to put too fine a point on this, but the civil rights movement, was about Coca-Cola lunch counters where they discriminated based on the color of the customer's skin. Coke machine won't do that. And so the issue of moral hazard and trust is meant to be swept out of the smart contract, that someone makes a promise and the machine makes them keep the promise unconditionally. Now, here's a well-known example. This is, if not the first smart contract, the first maybe real one that was used by a company. This is the French insurance company AXA, which is one of the bigger insurance companies in Europe. And they launched this product, which they called Fizzy, which is a flight delay insurance product that was built on top of Ethereum. And I think most of you guys probably flew here like I did. My flight was on time, which was a pleasant surprise. But if you'd insured against late arrival and your flight was more than 2 hours late, what you would do is send Ether to the wallet for each flight. And then if your flight's late, it returns your Ether plus a risk premium. And that risk premium is the job of the underwriter, who thinks about the weather, the day of the week, all kinds of things that might cause flight delays. So this actually ran successfully in the sense that the technology worked. They let it run for about 2 years. But the whole reason here is that people worry about insurance companies keeping their promises. You guys probably have health insurance like I do, and you probably have family members or yourself, you go to the hospital or get sick once in a while, and then they don't pay. They say you had the wrong prescription. We don't cover that one. You shouldn't have gone to that doctor. You should have been out of the hospital a day early. They go through the adjustment process and they whittle away your claim. And so people don't trust insurance companies. The point of the smart contract is to take trust out of the equation. This removes the ability for the insurance company to push back, and a machine keeps the promise for you. Yeah. Yep. Right. It's an interesting question about whether you might be overwhelmed by the complexity of a smart contract in a similar way. Like, we were covering this just yesterday in class, and my colleague said, who actually reads the code? You know, it's the same question as who actually reads the fine print. And I think, you know, that there is a very valid question there, but on the other hand, we can audit the history of these and see how many times people have not gotten what they expected. You know, that there's an audit trail here which is invulnerable to being censored and so forth. So there have been other smart contracts like in gambling, fair lotteries, and casinos, where you can make sure that the odds are not rigged against you by looking at the history of the payouts and so forth. Because after all, insurance, this contract is really just about gambling on flight delays. So, yeah. Yeah. This is a foundational result in law and economics, the idea of the efficient breach of contracts. And I always bring this up in class. What I say next, though, is that blockchains with artificial intelligence may figure this out. And you might be able to give them that flexibility, maybe not today, but maybe in a few years. But I think this is an interesting problem, that sometimes both parties would agree to stop the contract, but the machine keeps going. And you also get situations where the smart contract is illegal under the law. Like, you know, you promise something that the law explicitly forbids, but you can't stop it. So I play a video in class of an auto loan where if you don't make your payment by the first of the month, it simply shuts off your car. And in the video, the car stops on the highway. You know, just ching. And not only is this a safety issue, but this is in Nevada, where there is a 30-day consumer protection grace period. So you could, in principle, do this, but not for another 30 days. So this leads to a class action lawsuit. And who exactly do you sue on a decentralized, you know, these are great problems for the law students. There's a whole area of blockchain law that is beginning to grapple with some of these. And I think the questions you guys are asking are exactly the right questions, but this technology is coming much quicker than makes some people comfortable. So you can say this is good or this is bad, and I try not to take an opinion on that, but I just want to point out that it's out there and it's operating. So I want to skip ahead in the interest of time. I'll skip my mortgage and the auto loan. I want to talk about a very famous smart contract gone wrong. So there is kind of a science fiction-y idea called a decentralized autonomous organization, or a DAO. And this is a company with no employees. It's a company run by computer code. So in the future, you've probably heard about the professors being replaced by Siri. And, you know, this is taking that idea even further. And there was a DAO that was started in April of 2016, and the developers from Germany very ambitiously named it the DAO. So it's not just a DAO, but it was the DAO. And it was meant to be a venture capitalist, where you would send Ether to the DAO, and then a group of curators would look for projects, and there would be votes about whether to invest. And then after a certain number of years, you would get your Ether back with profit. In other words, this would look a lot like a private equity or venture capital partnership, but run by code. So would you send some of your money to this DAO? You can reflect on that, but I can tell you that it raised $50 million really quick. People were very excited. And then a professor at Cornell, Professor Sirer, who is a very good man, widely known in the crypto community, he put out a little note saying there are some problems with the code. Some of the lines are out of order, there are back doors, things could go wrong. Maybe we should have a moratorium. And to skip a few steps, there was no moratorium. The thing just steamed ahead. And then on the night of June 16th, somebody followed the playbook, more or less, of Professor Sirer, and broke in and stole a third of the Ether in the DAO. And this caused a huge panic. And so this was a project not of Ethereum, but just of some startup business that built it on top of Ethereum. But what everyone did, of course, was wake up Vitalik in the middle of the night. And they said, what should we do? And they tried counterattacking and white hat attacking, this and that. But in the end, what was decided was to roll back the blockchain until the block before the intruder comes and just erase, essentially a mulligan. And this was put to a vote, and 85% voted in favor, but 15% held out. So there were a number of long-term fallouts from this. The first is that 15% minority didn't take the fork and stayed with the old blockchain. They're still out there. They call themselves Ethereum Classic, and they are the true Ethereum, untainted by the rollback. The other thing that happened was, very predictably, someone else had a bad contract, and they woke up Vitalik. They said, hey, could you do another hard fork for us? And, pretty quickly, the incentives, the slippery slope became clear that they probably shouldn't have done this. There was a very interesting debate because you had two things that happened that shouldn't happen on a blockchain. They rewrote history, and they essentially intervened and pulled the plug on a smart contract. And when we say they, it's very clear who they were. The people at Ethereum headquarters did an emergency patch and got everyone to go along. And I love this quote from Vitalik, where he says some Bitcoin users, and this has nothing to do with Bitcoin, but he drags Bitcoin into it. He says they see the hard fork as in some ways violating their most fundamental values. Like, yeah, that's exactly what happened here. And he then continues and he says, with the wisdom of a 23-year-old, I personally think these fundamental values pushed to such extremes are silly. So, the next big one was this company called Parity Technologies, which froze by accident 280 million worth of Ether in a wallet. So this is not lost because everyone knows where it is and you can see it there. But the private key to open the wallet was deliberately deleted by a young researcher who made a mistake. So they want to get this unfrozen, and they've been asking now for almost 4 years. And the Ethereum people now have wised up, and they're not letting, but they're saying, well, just stay with us. Give us another year or two maybe. And there are many other debacles where an astute rewind to the blockchain could rescue people from stupid mistakes. But obviously, the incentives to write good code would be deeply compromised. We never did find out who the intruder was. We only know their address. And they contacted my colleague, Drew Hinkes. He's a practicing lawyer who teaches a course with me in New York. And they asked Drew to represent him in a lawsuit against Ethereum to try to get the rollback, to get the Ether that he stole, to allow him to keep it. And it's an interesting case. Drew wouldn't touch it. He said that these are Eastern European mafia people. This would be far too dangerous for me. But I really wish that he had. So this is the professor, and I've been on panels with him. It's not him. A lot of people said he must be the intruder. He'd be the last guy in the world. And this is the programmer who wrote the bad code. I mean, that's the guy you really want to sue, but like most software engineers, very few assets. So let me talk about DeFi. And yeah, we have 10 minutes. So the growth of DeFi has been absolutely phenomenal. This is on a logarithmic scale. And what is shown is the so-called value locked, which is the number of money deposited into decentralized finance platforms that perform basic risk management. Now, this is sometimes called Lego finance, which I think I used this term 20 or 30 minutes ago. If you look at the role of Ethereum, it is the so-called platform that settles all of these contracts. And on top of Ethereum are all these tokens, including the non-fungible tokens and the ICO tokens and so forth. Ethereum, as of January, had more than 350,000 of these. So people sometimes look at coin market cap and they say there's now 12,000 coins. No, there's 30 times as many and counting. And you can literally go home and create your own this afternoon if you're interested. And then the protocols of decentralized finance are essentially the smart contracts. Someone writes a smart contract for a loan. And then if it's an installment loan for 36 months, it just takes the payment out of your wallet 36 times, not unlike what my bank does to pay my mortgage that I've opted into. And interest is paid. You can have derivatives like futures that refer to prices in the market for petroleum or whatever you're interested in hedging. But these will all be software versions of products that are very familiar to you. And then the application layer is where you kind of attach these together in funky ways that create exotic derivatives, which you'll learn about if you take futures and options as a MBA elective and so forth. So all of this is done by code, and you as a customer come in at the top into what is called the application layer. So this is a very simple lending contract where you deposit Ether, which becomes wrapped Ether, which gets put into a pool, so it's now pooled Ether, and then it gets locked into a vault in exchange for a stable coin called the DAI stable coin that's worth $1. Now, if I lock my Ether in the vault forever and just take the equivalent in $1 stable coins, another word for that is a sale, if I never come back, right? Does the tax collector know? Not really. And even if they did, arguably this is not a sale. So I think what a lot of this DeFi is doing is putting together smart contracts in a way that allows you to accomplish very straightforward financial transactions free of disclosure, tax, regulation, and so forth. I don't know if any of you were watching the conference at Cornell about 6 months ago, but Cam Harvey gave a keynote on DeFi. And then I was asked to interview him afterwards, ask him some questions. And my first question was, Cam, isn't this just regulatory arbitrage? He says, well, you're oversimplifying a little bit, but I think the motivation of a lot of the people on DeFi is to avoid taxes. However, this is very interesting technology. And if you look at how this stuff works in real life, you don't have 24/7 availability. And you do have lots of moral hazard and adverse selection problems that can be eliminated on an open source platform like this. I think this technology has legs, and the industry that it could put out of business is the insurance industry. The insurance industry is well aware of this and has tried to tech itself up and keep up with this, but like the banking industry with payments, they've run into real regulatory barriers, that typically insurance, which is regulated at the state level, can't do things like this and stay in compliance with capital requirements and reporting requirements that the state requires. So I think we're headed for a period of great change, but both the derivatives exchanges and the insurance industry have a lot to be worried about. And again, the foundation of all this is Ethereum, where all of the tokens, the DAI tokens, the wrapped Ether and so forth, they're different versions of stuff on Ethereum. And Vitalik is, building these things out to allow all these people to move in and, occupy space and conduct, really stuff that's been part of finance for hundreds of years, but in a totally new way. So I think I've got 5 minutes. Let me skip the ICOs. You can read our paper in the RFS. We got the cooperation of this one ICO called Filecoin. And I don't know if our reviewers are in the room, but they really wanted to take Filecoin out of the paper. And I insisted on keeping it in. And they sold these Filecoins for like $1 each, which astonished people. They raised $200 million. Today, it's 66 per Filecoin. And it's one of many ICOs that have just gone to the moon. The SEC has been screaming about fraud and investor protection. What about capital formation? It's just astonishing what the rates of return have been on these ICOs, and you never hear about this. But this is another story for another day. I hope you invested in one or two of these, but if you had, you probably wouldn't be at the conference. You'd be, in Bahamas or something. Yeah.
Is this wealth generation or is this coming from others? So are they actually building wealth here or is this just taking stuff out of it?
Well, Chainlink is a token that connects external data sources to smart contracts. So it's a utility provider for the DeFi industry. And, how much risk management has migrated onto DeFi platforms? Or is there organic creation of new demand because of the ability to evade taxes? I don't know the answer to that, and I think it's a good research question. It's probably a mix of both. It's still small relative to the main industry. The BAT token is for the Brave browser, which has an internal advertising market where you can suppress ads and reward people who create good ads and so forth. I've been told that the Brave browser will overtake Google Chrome. And so that ICO raised 35 million, and those tokens today are worth 30 times as much. And Jay Clayton's furious about it. So whatever. So let's talk briefly about the NFTs. An NFT is a token that essentially points to an asset in storage. And by far the most famous NFT is for this work of art by Beeple, who is a new generation digital artist. And this was sold, you may know, for $69 million at Christie's just this past spring. I think it was in April. And this makes Beeple the third most valuable living artist. And this didn't come out of nowhere. So a non-fungible token, it's a unit of data. It certifies that an asset is unique. So anybody can copy perfectly the Beeple mosaic. And in fact, I copied it for this, here's a copy right here, and you can all download this and so forth. But only one person holds the true original, and they have the NFT that identifies them as the owner. So the NFT is really about authentication. And I've been asked this question in a lot of art conferences, and most recent one was just last night. Like, if you can perfectly copy it, where is the value? And what I say is that this is about prestige, that art collecting is really about bragging that I own it and you don't. And so this pushes it to the limit that even if we both have exact copies of the Beeple, I have the NFT and you don't. So I can, get the social standing and so forth. And, there's a whole bunch of these. The first class of these were the CryptoPunks, who were started in 2017. And they've become very valuable. There's exactly 10,000 and each has its own certificate. And only 9 of them fall into the family of aliens. And these are like being exhibited at the Museum of Modern Art and auctioned off at Christie's and Sotheby's and so forth. What I've heard is that they're now going to have like a children's cartoon with the CryptoPunks. They're doing the Disney thing and trying to monetize these. And the big commercial success has been the NBA Top Shot, where they take basketball highlights and essentially turn them into NFTs. You get a pointer to a video clip. And this is the baseball card of today's generation. In fact, my son, who is in the sports marketing program at Syracuse, they do this like all day, think about how to use this in sports. He's calling me up, for crypto advice about this, which I think is kind of fun. But without a lot of surprise, this has now been rolled out to Formula One, European football, I think hockey, and so forth, that they've been able to do. You can see the numbers for yourself. In the first year, almost $1 billion in sales, and they're licensing this stuff with the league and so forth. And you can have NFTs for Louis Vuitton handbags, for the diamond on the ring to authenticate where it came from, and for things for like supply chain and for pharmaceuticals to authenticate them and so forth. It's a very interesting way of fixing ownership that is, beyond impeachment. And the application in the arts is the one that has really gotten the most publicity. And I think there's a degree of disbelief. But really anything can be turned into an NFT. And one of the very famous ones was Jack Dorsey, who sold the first tweet. He said, who wants to own the first tweet? And he auctioned it off for $2.9 million. So I see a lot of head shaking and skepticism. This is a very fun area, and there are so many topics. They're just, like raining out of the sky. And a lot of people thought that this was going to go away. I mean, my colleague said, you're really going to spend your time on this. It's fascinating. You can't take your eyes off this. And when you really look closely at the consensus and the way these blockchains work to create trust, it's much better than the financial system, much better than double entry bookkeeping and so forth. It's a really exciting technology. So I appreciate, all the attention, you guys, the questions. I hope everyone's learned something, and I certainly did in preparing for the talk. And I really do hope, that some of you will go and write papers and take up some of these ideas, turn them into research projects. So thank you all very much. Thanks.